The banking structure which we are seeing nowadays is not very complicated. There are very few types of players, and you can count those players on your fingertips. There are scheduled banks and non-scheduled banks. Within them are commercial banks and cooperative banks. Within commercial banks are public sector banks, private sector banks, rural banks, and foreign banks. There are new types of players which have come into the banking system in India. They are payments banks and small finance banks. Reserve Bank of India is the authority which regulates the entire banking system in India. This entire banking system is not very old, because Allahabad Bank, the oldest bank which got nationalized, came into existence in 1865, 155 years back. Indian Bank, I think, came into existence in 1907. When Allahabad Bank, Indian Bank for that matter, many other banks were working in this country, there was no authority to control them. There was no institution to regulate them, because Reserve Bank of India came into existence only in 1935, when Reserve Bank of India Act 1934 was enacted. And even at that time also, Reserve Bank was the banker to the government, and it was the sole authority to issue banknotes. Reserve Bank got the regulatory powers in 1949, when Banking Regulation Act 1949 was enacted. Once RBI got the regulatory powers, RBI asked all the banks working in this country to get themselves registered under the second schedule of Reserve Bank of India Act 1934. RBI offered them certain benefits also, that whichever bank will get itself registered under the second schedule of Reserve Bank of India Act 1934 will be able to participate in clearinghouse system, and that bank will be eligible to borrow money from Reserve Bank of India. Reserve Bank put certain conditions also, that bank will have to comply with the instructions, guidelines, and directives of Reserve Bank of India, and that bank will have to share such information as required by Reserve Bank of India from time to time, and that bank will have to keep deposited permanently with Reserve Bank of India minimum of 5 crore of their core capital. Friends, at that time, most of the banks agreed to get themselves registered under the second schedule of Reserve Bank of India Act 1934. Those banks were called scheduled banks. A scheduled bank is one that is included in the second schedule of Reserve Bank of India Act 1934. Few banks did not opt to come under the regulations of Reserve Bank of India. रिजर्व बैंक अगर चाहता है, रिजर्व बैंक वांटेड, रिजर्व बैंक would have asked them to close the business, but Reserve Bank allowed them to continue as non-scheduled banks, because financial inclusion at that time in India was very meager. Had Reserve Bank closed those non-scheduled banks, the public who were getting the banking facilities would have been barred from getting banking facilities from those banks. So, friends, banking in India after independence for a very long time, it was going on at a very slow speed without much change into it. First big change came in 1969, when Government of India nationalized 14 private banks. Another big change came in 1980, when government nationalized another batch of 6 private sector banks. These private sector banks were called public sector banks, because shareholding in these banks of government of India was more than 51%. A public sector bank is one in which the shareholding of government of India is more than 51%. So, friends, from independence up to 1980, practically there were two types of banks working in this country. There were development banks, or we can say development institutions, and the commercial banks. The names of development institutions were ICICI. It was not ICICI Bank. It was ICICI, IDBI, IFCI, UTI, HDFC, IDFC, etc. Names of commercial banks were State Bank of India, Punjab National Bank, Bank of Baroda, Union Bank of India, Indian Bank, Canara Bank, etc. So, working area of these development institutions and commercial banks were practically demarcated. Development institutions were in the field of giving loan for infrastructure purposes and for setting up of big projects. So, for setting up of infrastructure and big projects, big ticket advance is required. So, development institutions were in the field of giving term loan to these institutions. Term loan is one which is repayable over a period of time. Once the project was set up, the promoters of those projects used to approach the commercial banks for meeting their day-to-day requirement, and commercial banks used to give them working capital finance. The ticket size of working capital finance was much smaller as compared to the ticket size of infrastructure loan and project loan. But friends, as per regulatory guidelines at that time, development institutions could accept only fixed deposits from the public, where the commercial banks could accept current deposits, savings deposits, and fixed deposits from the public. Means the area of deposit mobilization or the area of resources mobilization as available to commercial banks was much wider than the area of resources mobilization as available to the development institutions. But the area of giving loan as available to commercial banks was much smaller as compared to the area of giving loans as available to the development institutions. If a bank is having deposits but it is not able to lend, it is a loss making proposition. So, to earn the interest income and to increase the profitability, commercial banks started giving loan for infrastructure purposes and for setting up of big projects. In other words, we can say commercial banks encroached upon the areas of development institutions. So at that time, these development institutions approached Reserve Bank of India and Government of India to allow them to set up a commercial banking subsidiaries so that they could also tap current deposits and saving deposits from the public. So, agreeing to their request for the first time after independence, Reserve Bank of India granted certain banking licenses in the private sector. In 1994, Reserve Bank of India granted licenses to ICICI Bank, HDFC Bank, Axis Bank, IDBI Bank, and IndusInd Bank. Actually, the license was given to UTI Bank. The name of UTI Bank was later changed to Axis Bank. These private sector banks were very high tech from the very beginning. So, with the coming of these private sector banks, an era of competition started between public sector banks and private sector banks. And because these private sector banks were high tech from the very beginning, to compete with them, public sector banks were also required to adopt technology. So, with the coming of these private sector banks, an era of technological advancement also began in the banking sector. So, friends, from 1994 onward, banking in India was going on at a much higher, much faster speed with competition, with technological advancement. Then in 2004, Reserve Bank of India granted two more licenses, banking licenses in private sector. Those are given to Kotak Mahindra Bank and Yes Bank. Again in 2015, Reserve Bank granted two more banking licenses to IDFC Bank and Bandhan Bank. Friends, in 2015 itself, Reserve Bank tried to give a new direction to the banking industry in India. Reserve Bank issued certain banking licenses to such entities. The working area of them were entirely different from all these commercial banks working in this country. These banks were called differentiated banks. In 2015, in one stock, Reserve Bank of India issued 11 licenses for setting up of payments banks and 10 licenses for setting up of small finance banks. Friends, why the payments banks and small finance banks were called differentiated banks? What is the difference between payments banks, small finance banks, and all these commercial banks? Friends, the payments banks and small finance banks, they can do all type of banking activity which a commercial banks can do. They can accept deposits, they can remit funds, they can park their funds in government securities, they can park their funds in gold treasury bonds, they can sell mutual funds, they can sell insurance products. So where is the difference? Payments banks can accept deposits, but they cannot lend. And in deposits also, payments banks can accept only current deposits and saving deposits. They cannot accept fixed deposits. And further, balance in one deposit account with payment bank cannot exceed 1 lakh rupees at the end of the day. Means supposing if I want to open an account with payment bank, I cannot keep more than 1 lakh rupees in my bank account. Friends, whereas small finance banks, they can accept deposits, they can also give loan. But the ticket size of loan cannot exceed 25 lakh rupees. Means to one borrower, they cannot give more than 25 lakh rupees. Whereas commercial banks, they can accept deposits, they can give loan also without any limit. There is no restrictions on commercial banks in accepting deposits from one depositor as the restriction is applicable over payments banks. There is no restrictions on commercial banks for giving loan to one borrower as the restriction is applicable over small finance banks. But of course, at the time of giving loan, commercial banks have to ensure that they have got sufficient regulatory capital with them. Friends, another difference is that the payments, there is no stipulation of priority sector lending on payments banks. Since they cannot lend, so the stipulation of priority sector lending does not, the question of stipulation of priority sector lending does not arise. As we all know, for commercial banks, they are required to give 40% of their total credit portfolio to private sector, no, to priority sector. And this stipulation for small finance banks is 75%. Means small finance banks are required to give 75% of their credit portfolio to priority sector. Friends, this is how banking sector from independence, rather we can say for the last 150 years up to this, has evolved. But friends, over the last 4 to 5 years, we have witnessed a new change in banking sector in India. That new change is consolidation of public sector banks. During the last 4 years, Government of India has consolidated 27 public sector banks into 12 public sector banks. In 2017, all the subsidiaries of State Bank of India were merged with State Bank of India. In 2018, Dena Bank and Vijaya Bank were merged with Bank of Baroda. In 2019, which was implemented with effect from 1st of April 2020, most of the other banks were merged together to form bigger entities. Oriental Bank of Commerce and United Bank of India were merged with Punjab National Bank. Syndicate Bank was merged with Canara Bank. Andhra Bank and Corporation Bank were merged with Union Bank of India. And Allahabad Bank has been merged with Indian Bank. At the time of announcing the consolidation of public sector banks, the government of India has made its intention very clear that the government wants only three types of public sector banks in this country. Government made intention clear that government wants one type of banks will be having strong national presence and global reach. These banks will be of international character banks. These banks will be international banks for India. And second type of bank will strengthen the national presence. They will be national banks for India. And third type of banks will strengthen the regional focus. They will be regional banks for India. So, friends, as per the classification criteria, government has also made its intention clear that international banks will be State Bank of India, Bank of Baroda, Punjab National Bank, Canara Bank, Union Bank of India, and Indian Bank. National banks would be Bank of India and Central Bank of India. And regional level banks will be Indian Overseas Bank, UCO Bank, Bank of Maharashtra, and Punjab and Sindh Bank. As per the business figure available at the time of announcement of consolidation of banks, State Bank of India would be the largest bank of India. Second largest would be Punjab National Bank. Third largest would be Bank of Baroda. Fourth largest would be Canara Bank. Fifth would be Union Bank of India. And sixth would be the National Bank, Bank of India. And seventh would be the International Bank, Indian Bank. Eighth would be Central Bank of India, National Bank, Central Bank of India. After that, the number of regional level banks comes Indian Overseas Bank, UCO Bank, Bank of Maharashtra, and Punjab and Sindh banks. Friends, though Government of India has not clearly demarcated the working areas of these international, national, and regional level banks, but government has made its intention very clear that the government wants that the global level banks, international banks will focus for project and infrastructure financing, and they will be having overseas presence. They will be allowed to open overseas branches. Whereas national level banks, they will meet the needs of SME sector, thus aiding Make in India. And the regional level banks will concentrate on the retail and priority sectors, tax collection, and miscellaneous functions such as financial inclusion and subsidy distribution. Friends, this is how the banking sector in India has evolved